Hi. So, good afternoon. Today we're talking on investing in financial instruments. So, basically, we want to talk about the different financial instruments that we have available and what they are all about, how you can access it, how you can be a part of it. Basically, financial instruments. Though there are other form of investment, but we're looking at financial instruments like your bonds, your treasury bills. So we'll talk more about that. It's a foundational training in a series of training. So this is the first class, and after now we'll do subsequent classes that will upload video. This class is bought by Magda Services Limited, that is basically into investment education, investment advisory, and investment management. So, my name is Magdalene D, and I'll be taking these classes. Thank you. Okay, so let's get into the class. What is investments or what is investing? So, I searched online, basically, Googling it. This is what I got. Investing is committing resources, money, or time into something with the expectation of generating profits, benefits, or returns in the future. So when I first saw this, this definition, I was going to rephrase it, but I tried against it because I felt like you could also lose money while investing. But I realized that nobody invests to lose money. So when you call something an investment, when you are going into an investment, it's with the aim, as they said, to either generate profits, benefits, returns. Obviously, sometimes there are losses, but that is not really the aim of going into investing. That's not investment, or an asset is different from the word investing. So I was looking at maybe an asset, but it was like you're looking at investing. So when you are investing in something, you want it to generate profits, benefits, or return. Obviously, you could end up losing. So that's it did not you get it could be loss. But the aim was actually is always to profit, benefit, or returns. Next is types of investment tools. Type of financial investment basically. So there are different type of investments. There are some that are financial, there are some that are not financial. So type of investment, sometimes we always be investment in terms of money, but you could invest your skills, you could invest your time. So when you went to school, some of us went to primary school, secondary school, university. That's investment of time. We invested our time for what we are now using to earn our living monetary. Your skills and your knowledge, when you're employed in a work, in exchange for money, you give them your skills. And the company is paying for your skills. So they are employing you, they're investing in your skills, or they are paying you so that you can use your skills. So they are purchasing skills in the return that skills will be put to use so that they can earn more money from what they currently earn, or they can be earning just as much as they are earning. So skills and knowledge, when you acquire them, are also investments. When you go to acquire skills so that you can use it in exchange for money. Then there's personality in investing. We know, like celebrities and influencers, it's amazing how many people will buy a particular brand just because of somebody they know, a celebrity is on them. So those people have invested in their personality. How they grow it is different. Some people have been acting, some people is just via through social media and they blow. So their personality, some people have a way they work, their poise, their elegance. Some people, but now it has gone so streetwise that some people are even street personalities can also be influencers. So those things you can influence in your personality, and then you could in exchange get money for that. What we are dealing with today, financial investments. So financial investments or financial instruments investing is investing in financial instrument. That's what the class is basically on today. We're talking of financial instruments investing. We are talking about investing in treasury bills, investing in mutual funds, investing in commercial papers, and those are financial instruments investing. And when you invest in that, they appreciate, they give you profits, they could give you loss, yeah, but profits, they generate profit and income for you. Real estate investments, as we know, properties, maybe land, houses, shops, property investing. So you invest, you buy property, and you could lease it out, you could loan it out, you could have a house that you put up for rent. So those are things you invest generally. You invest in them so that they can give you financial gain. So these are the types of investments that we have. Okay, so let's get to the first financial instrument we'll be talking about. That's the federal government bond. So federal government usually raise money or get loans from people that they give people at different rates. They get loans through different avenue, and one of them is federal government bond. So they sell like a bond to you, issue you a bond certificate, you bring your money, and for a stipulated amount of time, they give you a rate per annum. So federal government bonds are usually longer term, so maybe between 2 years and above. So you see federal government loans, they have other ways to raise money. So when they want to raise long-term loans, they want to take long-term loans, they raise it by selling a bond, issuing a bond. So the people that issue this bond is called the DMO, the Management Organization, I think, yeah, for Nigeria, I think so. DMOs, I just they were saying what's they are debt management. I think that's the arm that does it. So they manage it, and they every 2 weeks a new calendar comes. They issue bonds and other financial instruments. So usually they pay a rate. Like I said, this rate is called coupons. So sometimes they pay quarterly. By I think in Nigeria it's quarterly, because these things are not peculiar to Nigeria alone. In Nigeria, I think it's quarterly. From my research, it's quarterly. Some people pay biannually, some countries pay yearly. But the rate is in per annum. So what that means is that if you buy a federal government bond and they say it's 12%, what that means is 12% per annum. You get 12% of your money per annum. Do you get? So even if you are doing a 5 years bond, every year you get 12% of your money until maturity time. That's the term of the loan. When it ends, that 5 years is the term, the maturity time. So at that 5 years, when it ends, that's when they now give you your money, and then they give you 5% for that same year. But every year before that 5 years, they will be paying you coupons, which is now the 12%. So that's how federal government bonds are usually. That's how federal government bonds are usually done. Thanks. Hi, so treasury bills, they are shorter term loan instruments used by the government. So they are bills sold to the government to public. The government uses to raise money. So it's like you loaning your money to the government. So the government takes it and gives you a rate for it. They're borrowing your money at an interest rate. So they are called treasury bills. But unlike bonds, they are shorter loans instruments, and they are basically in the currency of the country. That means ours is basically in naira. Unlike bonds, bonds can be issued in foreign currencies like USD, but this one is only in naira, and the durations are usually shorter. So you have 3 months, 6 months, and 9 months. But the rate is always issued in per annum. So if somebody tells you 12%, what they are saying is 12% per annum. If you are holding for 3 months, then what you get, the percentage you get is 3%, because 12% 1% per month as 3%. So whatever you get, they have to convert it to the equivalent time when they give you the rate, so that when they tell you, you don't feel that they are cheating you or something. So you can buy directly from the government, which is the primary market. So when the government issue, usually the minimum amount to buy from the primary market is very high. So because of that, most people buy from the secondary market. There's a minimum amount before you can buy directly from the government, and there's a maximum amount you get. So minimum from the primary market, then minimum for the primary market is high. So most most asset management company or banks will buy from primary markets, that's directly from the government, and then sell to other people at a lesser rate than what they buy. But that's the difference, is their own gain, so it's normal, they bought for you. So they are like retail sales. When the government is like, they become like wholesale or distributors, and then they sell to you, do you get, in a retail fashion, do you get? So that's more like what's happening. So they are the secondary markets. You can buy from the secondary market when you're buying from somebody else or an asset management company. Those rates are lower than the primary market. Usually your interest is given upfront, so once you buy it, they will hold your money for that time, but they'll give you the interest immediately. So that's one good thing about treasury bills. They give you, if they say 12%, they'll give you 12% of your money and then collect the balance. Do you get? That's what they will use and hold till when treasury bills rates is, till when the time or the tenure or the time you people agree is done. Then they can now give you back your money. It's a good way to make money. Another one is equities. So equities are stocks. So stocks are shares of a company that carry no fixed interest. So unlike treasury bills and bonds that you have fixed interest, where the government say, come and borrow me your money, I will give you at a fixed interest. Treasury stocks is like partnering with a company, buying into a company. So you see the prospect of this company, they've been doing well, they are well known, their books are nice, you get, in terms of their results, they are making profits. So you can buy into them, buy a part. So it's like a pizza in size, with their different sizes or different slides. So you bought a slide of the pizza. So a particular company shares is like making it like a pizza where people can buy different size. So each size is a share. So you can buy multiple shares. There are Nigerian equities, there are equities that we talk about, and you can buy the NGX. From the NGX, shares are usually sold from the stock markets. So you have the Nigerian stock markets, and then you have the US stock markets. Now shares can also be private. A company can also be private, so you can also buy shares from a private company. Now what we mean by shares from a private company is that those companies are not publicly traded. So it's not like in a stock market. So when it's in a stock market, it's publicly traded, so anybody can buy in. Once they go to that stock market, they've made it public. But private companies is certain individuals that owns those shares, and they like to keep it private. So except you are in that their network, they probably, you can't buy into it. Now when a company wants to go public, there's what they call IPO, initial public offer. So they do an initial public offer, they get the price of their stock, you get, so they get, like, there's a way they value the company as at the time they want to actually go to the stock market, and then they are able to get how much one share should cost, and then they list on the public market through what they call IPO, initial public offer. You probably have heard IPO. So that's when the company wants to go public. So some private companies might want to go public, make themselves houses. It's a way they used to raise funds to, you get, make themselves houses. So they make themselves assets. So you can now buy into them, and then you can also trade them. You can also trade them for a particular amount through the IPO process. So that's one way of purchasing stock when the stock is newly listed. Another way is you can just go to the stock market through your stockbroker. So there are different stockbrokers that are available. There are a lot of stockbrokers available. Stanbic IBTC stockbrokers, the ARM stockbroker, Meristem stockbrokers. So there are a lot of companies that have stockbrokers that are available that you can use the stock bits. They are like liaison between you and the market, the stock market. So they are like middlemen between you and the stock market. They use your money and then they go to market and then they buy stock at the current price. There are a lot of fintech app that you can use to track your stock. So it's not like before that you cannot know the price of your stock. Now you can use a lot of fintech app A lot of the stockbrokers even have apps that you can use to track the price of your stock, so that you can now buy those stocks at that price. You know how much you are buying, you know the value of your stock at any time. Another way that you can buy is through rights issues. So sometimes the companies want to increase their valuation or also raise more money, so they do rights issues. So when you talk of rights issues, they are only selling to existing stockholders. It's still a publicly traded company, but it's a way that they used to reward their shareholders. So if you currently hold the share of a company, they might say, instead of the company selling it to the entire public, they will now do rights issue where they sell directly to their shareholders, maybe at a discounted price, or maybe at they might tell you, for every one share you buy, we give you 3 shares. So they use it to raise money, and then they use it to reward existing shareholders. So those are way that companies raise public companies shares can be bought. Like I said, there are private companies and there are public companies. Equities are risky assets, it's worthy to say. Unlike mutual fund, unlike treasury bills where your money is guaranteed, and FGN where your FGN bonds, Naira bonds, where your money is also guaranteed. If the bond is issued in the currency of the country, it is stronger. Do you get? It's safer. Let me say it is safer because you are buying from the government. Do you get? So it is safer as opposed to other. If they are now in other currencies, it's a bit different because the government does not have control over other currency. So there's much more risks attached to bonds that are issued in the currency other than the issuing country's currency. So when Nigeria is issuing a USD bond, it's a bit risky. You get, as compared to a Naira bond. A Naira bond is safer, but most people go for the USB bond, even with the risks because of FX. It's also a protection against FX. So, but when you talk of now risks, equities are more risky, though it can be less risky if you buy what we call exchange traded fund. So exchange traded fund is like you're categorizing different stocks that are in the same sector are brought together to now make an ETF. We call them ETF. So you can have like a gold ETF where, look, I guess gold is now, or technology ETF where technological companies are brought together. Strong technological companies are brought together and are sold as one. You have energy companies where different energy companies are brought together and are sold as one. Now, the good thing about this one is that it distributes the risks. So they look at the biggest and the strongest companies in that sector and they bring them together. So the chances that all those companies will just not make it is very much reduced. So because of that, it is safer. So if you are starting off on stock markets, it's best you buy ETF, exchange traded fund. It can be of different sectors. So you can look at, if you are interested in energy, you can look at energy sectors and buy their energy ETFs. Example is like the S&P 500. There is S&P Energy S&P too that is available. Different stocks. The S&P is Standard & Poor. So they are like a body. They have different stocks that they bring together. They manage it. It's like okay, we'll get to a mutual fund, but they actually manage those ETF, those exchange traded fund, but it's passive management. It's not like actively being managed. They passively manage it. So their charges are less. Their expense ratio or their charges. So when you hear expense ratio, their charges are actually less when compared to other managed funds. Yeah, then we talk of mutual funds. So mutual funds are like ETFs. So I told you ETFs are passively managed, but these are more actively managed. So an asset management company, anything that yields profits or appreciates, you get. So they are companies that manage different assets. So they bring different financial instruments together and then they sell to the public. Remember, these guys are retail sales, so they make it affordable for the common man. As opposed to if you want to buy directly, it might be very expensive. So they now buy and then they sell in bits to people so people can access. There are mutual funds that are as cheap as 5,000 you can buy, and then the duration is shorter than treasury bills. So for some mutual funds, you can have your money after putting your money in a month. You can have access to your money anytime you want. So it can be used as a savings account. Now there are different types of mutual funds depending, like we said, they are categorized under with certain they're categorized with certain criteria. So you might have heard of the Sharia, fund where they raise money for doing certain buildings. Some mutual funds exist. Some asset management company offers such mutual funds. There are mutual funds that only deals with fixed income, treasury bills, commercial paper, equities, bonds. Those are like the safer ones. So those ones are also there. You might have heard of one of the very popular ones is money market. Why? Because your capital is guaranteed. So they invest in things like treasury bills, which you don't have risks, so much risk affect involved. They invest in fixed income, they invest in commercial papers, and they give you a rate that is fixed. They give you a rate, and they tell you that your capital is preserved, so your capital is guaranteed. So the money capital is the money you put in, so the money you put in is guaranteed. What is changing is the interest rate. So interest rate might increase, it might decrease, but your capital is guaranteed. So those are mutual funds. You can also have, some people do real estate mutual funds, just like real estate ETFs too exist. So, but mutual funds are more actively managed because these are asset management companies on their own that need to raise one. So mutual funds are actively managed. Then there's what they call short commercial paper. So commercial paper are short-term debt instruments issued by companies to raise fund. So another way companies raise fund besides selling their shares is also through commercial paper. So they are like doing what the government is doing. Why the government is giving you bonds and treasury bills, they are giving you a commercial paper for a rate. I'll give you this rate, and then based on this rate that I'm giving you, you would now give me your money, loan me your money for a particular period of time, and then I'll give you back the money with your rates. Do you get? So they are risky. They are risky investments. They are high risks. Let me not say every investment comes with a risk, but these ones are high risks. These commercial paper equities, they are high risks. So they are higher risk investments, but you can still have them, but they are higher risk investments. So you need to know the risks that comes. Like we have talked about mutual funds, treasury bills, and FGN bond where your capital is guaranteed. Do you get? FGN Naira bond where your capital is guaranteed. But then we are now talking about commercial papers and then equities, which are higher risk. So commercial paper are ways that companies use to raise funds. You give them your money, they give you a commercial paper at a rate, and then at the end they will not give you your money and your rates at the stipulated time agreed. So these are risky, but what you can use to reduce the risks is there are some reputable companies that that these companies, they will not fold up. They have been long here, so they've built credit worthiness. So big companies are advisable for commercial paper as opposed to smaller companies. Do you get? So big companies are advisable to go. So that's one of the way you use to reduce the risks of commercial paper when you see a company that is big and is established. So there's no guarantee. The company may default. Remember, there will be nobody to hold. Now, most of this thing we've been talking about rates. How are these rates determined? So there's what they call, we have inflation rates. So inflation rates is basically is the cost increase in the rate of change of price of goods and services sold in a country calculated at a particular time. So it can be calculated per month, it can be calculated per year, it's usually calculated monthly. So that rate, when that rate is telling us if prices are increasing, if prices are reducing. So when prices are increasing, you see inflation rates increasing. If when prices are reducing, you see inflation rates reducing. So based on that now, those rates, now the Central Bank of Nigeria uses it to, because usually prices don't just increase. When prices are increases like that, it's because people are willing to pay at that price. It might be scarcity of products, small goods, and then too much money chasing too few goods. So because of that, people will just the prices will just inflate because people have money to buy at that high prices. So what the government usually do is, in a bit to manage the inflation rate, the Central Bank of Nigeria has what they call a rate, MPR, monetary policy rate. So MPR, so this rate too, they change it too. They have their meetings and then they change it. But what the inputs into determining that rate is the inflation rate. So if they see that inflation is increasing, they would increase that rate, so that now that rate, when they increase it, that rate is what government used to say to determine treasury bills rates. Is what government used to determine FGN bond rates. Is what companies used to determine commercial papers rates. So because of that, if the rate is higher, most people would go to the government as opposed to go to commercial papers. You get? So if your okay, most people will go to the government as against commercial. So FGM bonds, if it is now higher compared to commercial paper or compared to buying, so instead of that money that you use to buy things and inflate price, you will just use it to go and buy commercial paper. You use it to go and buy mutual treasury bills. You use it for mutual funds too. You use it for treasury. Yes, you use it for treasury. You use it for bonds, FGN bonds. Why? Because they're trying to reduce the amount of money in circulation. So by increasing the rates, more people will now patronize going to buy, as against putting money even in the stock market. Because if you can get like 30%, then you know that 30% is a good rate. Let me go and put my money. 30% you didn't work for. So they use that rate to determine inflation rate is what determine what they call as rate. So they use that rate to manage the quantity of money in circulation. So if they want to discourage people from spending, they increase that rate. So more people will patronize treasury bills and FGM bond as against buying or spending, so that is much more, which will increase inflation. So that is that. So I think that's basically most of the financial instruments, but there are some other financial instruments that are not really well used, or we use them or we do not, but we do not consider them investment, but they are. If you look at insurance policy, so your insurance policy is another way. So you can have a car insurance. Imagine you run a business, a logistics business that involve a lot of cars, or a cab hailing business. You can insure all your cars that way. You can do a comprehensive insurance. There's comprehensive, there's third party. Comprehensive covers more. Maybe they'll say accidents and then some other damages. It covers repairs for more damages than third party. So those insurance companies can also be an investment. If you look at the money you spend as a car hailing company on repairs and damages, you might want to insure yourself by reduce your cost by taking insurance policy. Do you get? Even as a private car owner too, if you feel there's a risk, you can also. Another thing is health insurance too. As against going to the company or going to pay for health. If you have kids especially, you can just do health insurance. That's even if it doesn't cover the entire bill of the hospital, it helps you subsidize the cost, especially for families, because children, there are some that offers dental, some of them offers gym. There are a lot of things they now cover, which are regular things that people do: dental care, optical checkup. So those things are covered under insurance company, that if you want to do a one-off, is more expensive. So that could be an investment to also reduce your cost. Those are things you could look at. Cooperative too. Some people say, cooperative, is it really an investment? I think it is, because a lot of people take loans from cooperative and then use those loans, because they are members of a cooperative, they now use those loans to buy houses. Do you get? So a cooperative can also be a form of investment. Mortgage loans too can also be a form of investment, because if you use a loan to buy a house, the house is an asset, so it's appreciating. Even if the value of your money at a reasonable loan, there's what they call NHF funds or NHF loans. So if you're a working person or you own a company, you're supposed to pay 2.5% to NHF, that's National Housing Funds. You're supposed to contribute 2.5% of your monthly earning into a National Housing Funds, and then they will not give you a loan. That gives you access to a mortgage loan. So if you get a mortgage loan, you can use it to buy an asset, which is an house, and that asset appreciates. So all these are other financial instruments other than what we have. So that's the class. In conclusion, so we have passive and we have active investments. So the passive investments, like we said, mutual funds, treasury bills, these are kind of managed by certain companies for you. They are made available to you by asset management company. So you could use it, as a worker, especially as a worker. You can use it to scale up or meet one or two expenses that you have in your houses, and that would help you. So beyond any, when you are, see it like this, even if it's 1 month salary that a passive investment does, that your money works for you to get, is 1 month that nobody will be willing to dash you normally. So at least you have gotten 13-month or 14-month salary for those that collect 13 months, as against your normal 13 months or 12 months, as the case may be. So these are things you can look at. These are the ways you can look at ideas of investing in financial instruments that are mainly passive and then can help you get extra bucks to live your life. So thank you so much for your attention. Thank you for giving Magda this services a listening ear. You can contact us. Our contact details will be shown on the screen, so you can contact us so that we can, let's make money together. So you can contact us. It's Magda Eddie Service Limited. My email is eddie.magdalene.wordpress.com. My Gmail is edmagdalene@gmail.com. Yeah, so my phone number, all my details are there, so contact me if you need more information on this. Thank you very much. Have a nice day.